Good evening, everyone. Myself, Niranjan, your host, and I am joined in by our CIO, Mr. Vetri Subramaniam, and Fund Manager of UTI Focused Fund, Mr. Vishal Chopra. Welcome to you both on this webinar. And yes, audience, if you are looking for an update on equity markets, valuation, economic trends, and also investment strategies, I think this is the webinar for you. And you can also get your answers to your questions from our speakers. So send in your questions on the chat box, which we can actually take in once the Vetri's and Vishal's initial deliberation gets concluded. And without further ado, I will now hand it over to Vetri. So to take this forward. So thank you and over to you, sir.
Yeah, good evening, everybody. Welcome to the monthly Market Insight webinar for March. And of course, as Niranjan already mentioned, my colleague Vishal Chopra is with us today on this. He's been an analyst at UTI now for almost, he's been with UTI for almost 15 years. We started off as an analyst, and now, of course, he manages several of our funds. And today he's going to be talking about the UTI Focused Equity Fund. So what I'm going to do now is have my colleague Niranjan pull up the presentation, which we'll be taking you through. So initially, we'll start off with the macroeconomic trends, some of the things that we wish to highlight. And from that, we'll move on to talk about what we always do, which is where are we in terms of valuations, and then in terms of some of the other trends that we are seeing in the marketplace. And after that, we'll move on to the discussion over the strategy. So Niranjan, we can just move ahead. Now, this has been a very interesting, last 1 month in Bombay. This is the season for conferences with large number of companies coming and meeting investors like us. And of course, it's also the season for when many investors from all over the world tend to flock to Bombay because it is conference season. And so it's very easy for global investors to come down to Mumbai, and over the course of a week or 2 weeks, you can get to meet, 30, 40, 50 companies at different conferences which are going on. And this time, I think we saw some record number of foreign investors at some of the conferences. At least that's what the investment banks and brokers are telling me. And what we have on this slide is maybe one of the reasons why increasingly global investors are tending to look towards India. What you can see over here is 2 slides. One is India's contribution to world GDP growth. You can see that on the left-hand side. Going into the 2000s, we accounted for less than 3% of total global growth on an annual basis. But today, the situation is that we are accounting for as much as about 6% of global growth. So we have almost doubled. And it's estimated that by 2028, we would account for just slightly under 8% of annual addition to global GDP. So India has certainly become one of the significant contributors to world GDP growth. Obviously, US and China are in the lead, but India's contribution now is increasingly quite significant. Not only is our contribution to growth significant, on the right-hand side, you can also see how India's demographics places us in a very, I would say, advantageous situation, which is that as large parts of the world witness people who are exiting the working age cohort, in India, we are actually adding large number of people into that age group of 30 to 60, which are the prime years during which individuals work and contribute and earn income, not just for themselves, not just to meet their aspirations, but in doing so, they also become, drivers of growth in the economy as a whole. So when you look at the right-hand side, you can see China, Europe, Japan, all of them are actually likely to experience a reduction in total workforce defined as the age 30 to 60 over the next 20 odd years, whereas in India, we will be adding pretty much a workforce which is equal to that which is exiting. And that gives India the opportunity to not only create jobs, but also to be able to create much more productive jobs than what we are currently doing. So this is perhaps, the reason why more and more global investors are looking closely at the opportunity that exists in India. Moving on to the next slide. Now, as many of you know, the GDP numbers came out, the second advance estimate, which estimated that GDP growth would be 7.6%. And in fact, the RBI governor has even been indicating that for March 24, it could be closer to 8% GDP growth, which would be a fantastic achievement. Now, on the right side, what you can see is India's Capex cycle and India's consumption cycle. Due to the pandemic, we have actually seen a decline in the contribution of consumption to overall GDP, but that has been more than offset by a stellar increase in capital formation. So when you look at that right side, you can three periods from 2003 to 2012, then 2012 to around 2021, cycle 2. So in cycle 1, Capex outperformed consumption. In cycle 2 period from 12 to 21, consumption outperformed Capex. And now in the last few years, going back to 2020, we are actually seeing Capex do better than consumption. So this was reflected in the GDP data that came out at 7.6% as well. And one of the enabling conditions for this is what you see on the left-hand side, which is that when we look at the gross debt to equity of large listed companies, you can see that this number peaked in 2015, but after that it has been consistently coming down, and particularly from FY20 to 23, there's a very sharp reduction in leverage, and the reason for this is the massive boom which has happened in corporate profitability, and you will see this on one of the other slides as we go down this deck today. But this is something that is worth keeping in mind, that the last 4 years have been driven more by Capex than by consumption. This is driven by a huge surge in profitability, and a reduction in leverage of listed companies gives them the potential to continue to drive the Capex. Of course, Capex to GDP, as shown here, as sort of gross fixed capital formation, the dark line on the right, it is sort of moving back towards previous cycle highs, and we'll have to see how sustainable this proves to be. But this is sort of the backdrop that is there at this point of time within India and places us in an advantageous position. On the next slide, we are going to change gears slightly and talk about valuations. Now, as you're well aware, we'll be showing you the valuation slides, which we always show you much later in the deck. But the reason I show this particular slide over here is just to highlight one of the things that we have been pointing out, which is that when you look at the performance of stocks over the last 1 year, March 23 to March 24, the outcomes that you are seeing in terms of stock prices is a combination of earnings growth combined with an expansion in the PE multiple. So what this data is showing you is that the dark area is the contribution of earnings growth to stock prices, and the yellow shaded area is the contribution of PE multiple expansion to stock prices. Now, if you look at the Nifty 50, what the data is telling you is that earnings went up 17%, the PE multiple went up 14% for an aggregate gain of about 31%. If you look at the Nifty Next 50, which is the next 50 large companies, earnings did better. It went up by 26%. But the contribution of the PE multiple was even more significant at 34%. Then you look at the Nifty Mid Cap, it's almost half and half, 30%, 29% increase in earnings, 30% increase in PE multiple for a total gain of almost 60%. Then you come to the small cap, earnings growth 23%, far better than the Nifty, but just look at the increase in that PE multiple, or driving a price gain of almost about 72%, with 49% being contributed by expansion of PE multiple. And then of course you go down to the Nifty Micro Cap 250, even more significant contribution to price has been led by PE multiple multiple expansion rather than by earnings growth. So just two, takeaways to give you over here. Yes, there has been slightly better earnings growth in the mid cap and small cap segment of the market, but the big contributor to stock price has actually been P multiple expansion and not just the earnings growth. And that's the thing that we talk about, that the potential has already been discounted in the stock prices. Now it's down to implementation and earnings growth, and the bar is being very set very high when you see this kind of multiple expansion. Moving on from this to the next slide, we are actually going to now change our focus away from equity and look at what's happening in the Indian bond markets, particularly in terms of what are foreigners doing in the Indian bond market. Now, what you can see over here is data going back to February 21 in terms of the inflows on a quarterly basis into the bond markets in India from FPIs. Now, when you look at this, you'll see that there was a very mixed trend till about May, June of 2023. But from May, June 2023, there's been a consistent increase in FII flows into fixed income, into debt. Now, why has this happened? As many of you would be aware, in October 2023, India got included in the JP Morgan Emerging Market Bond Index. And just a few days ago, we also had the news that Bloomberg has included India in one of its smaller bond indices. Now, the estimate is that between the JPM Bond Index and the Bloomberg Bond Index, there could be a potential inflow of about 25 to $27 billion, 24 to 25 billion on account of the JPM bond index, about 2 billion on account of the Bloomberg bond index. Now, this will happen over a period of time for funds which are passive, or even for that matter, funds which are active, because the weightage of India in the bond market will go up gradually from June 24 on a monthly basis. But what we are seeing is that even ahead of the inclusion, foreigners have already started to, take a cue from the action of the index providers by starting to pump money into the Indian bond market. So from the announcement in October 2023, you have actually seen nearly a $10 billion inflow into debt. And interestingly, this is more than the inflow that has come into equity from October 23. From October 23, India has seen about $3.5 billion of equity inflows, but the bond inflow has actually been 3 times that amount at $10 billion. So this is a number that we would expect to continue in terms of steady inflows because of the inclusion of India in the bond indices. Some of this number may be pre-buying, and you could see some of these people come to perhaps book profits as and when the index inflows pick up. But fact of the matter is that over the course of a year, we should look to about $20 to $25 billion of potential bond buying from FPIs because of the inclusion of India in bond indices. It's worth noting that in India's case, we have opened our equity market to foreigners much before we opened the bond market. And even today, the access of foreigners into the bond market is still sort of limited, both by regulations as well as by rules. But certainly this globalization of bonds is a welcome development from India's point of view in terms of creating a new avenue for foreigners who wish to participate in India's growth to also be able to participate in our bond market. So we'll move on from this to our more sort of traditional sections that we talk about. First of all, we have something on the equity markets. Now, I normally don't spend any time on this slide, but the only reason I'm showing you this is that after a long time, if you look at the left-hand side, you can actually see that the small cap and mid cap index have underperformed the Nifty 50 and the Nifty 100. So on a 1 month basis, the small cap and mid cap were negative. Nifty 50, Nifty 100 up marginally. But of course, when you look at the data over 1 year, you can see that the gains in the small cap and mid cap far exceed the gains in the Nifty 50. And when you look at those gains on the right-hand side, remember the data that I showed you on the previous slide, where we talked about how much of the gain in the small cap came from earnings and how much came from P multiple expansion. And you will be able to now connect the dots between what I showed you 2 slides ago and these gains that you're seeing over here on the right side extreme. Let's move on from this to look at the earnings picture. And again, we can look at one component of this earnings picture in the context of what I told you earlier, which is that between 2020 and 2023, there was a massive increase in corporate profits in India. So just look at the Nifty EPS for March 20, 489 rupees. And then by March 23, it's at 835. And for March 24, we are almost at the end of the year, 955. So, literally over a 5-year period, you have a doubling taking place in terms of the EPS of corporate India. That has driven the recapitalization of corporate India in terms of bringing down its aggregate leverage. And that's why we said the enabling condition for healthy Capex is now very much in place. What do we think about forward estimates? As I said, this year is now pretty much in the bag, 14% earnings growth. But March 25, the expectation is once again corporate India Nifty 50 to report about 14% earnings estimate is the expectation. On the next slide, you can see how the EPS numbers have behaved over different periods of time. And you can see that on the left side, the first 4 bars, which is the estimate for March 20 for 24, the financial year 24, over the last 4 quarters, there has been a slight reduction in EPS estimate, but only to the tune of 2 to 3%, which is not very remarkable because if I think about previous years in Indian history, particularly pre-2021, in most years, the analyst estimate used to be 20% earnings growth. And by the end of the year used to land up with single-digit earnings growth. Whereas this year, we've actually, just about seen a marginal degrade from 17-18% earnings growth expectation to 14% earnings growth. And you can see the bars for FY25 and FY26. Once again, you can see the bars are more or less steady. And that's the trend we are seeing in terms of earnings expectation. Moving on, we now have the trailing PE and the forward PE multiple. Trailing PE multiple also now has pushed to the red line, which is the expensive zone for the Nifty 50. And on a forward basis, anyway, valuations now are in the expensive zone. This is based on the last 10 years valuation. Even if you extend this period, you will still find that the valuations are very much in the expensive zone. And we'll look at how the other segments of the market are behaving later. But let's also take a look at the price to book. The price to book was one of the metrics which had not gone into what we would call expensive territory. But with the recent rally in the Nifty in February, even the line for price to book is now gone into slightly expensive territory. Return on equity, which you can see on the right side, it's recovered almost to a 10-11-year high, but it's now sort of been steady for almost about 1 to 2 years in that 14-15% range. There's no sign of it moving any higher, and I don't think the estimates that we are seeing suggest that it is likely to move higher in terms of return on equity. Moving on to the next slide, this shows you the valuations for the Nifty mid cap and the Nifty small cap in terms of the trailing price to book. Immediate thing to notice is that 4.29 times trailing price to book on mid cap, 3.89 times trailing price to book on small caps is much higher than where the Nifty 50 is. The Nifty 50, if you don't remember, is at about 3.55 times. So this is one of those unusual times in history where not only is the mid cap more expensive than the Nifty, which has happened in my own career, but this is one of the few times in history where the small cap index itself has now moved to a premium to the Nifty, which is quite unusual in my experience. Moving on to the next slide, this is part of our valuation framework that we run at UTI. As you're aware, in both our balanced advantage fund and our multi-asset allocation fund, we run a internal model. This internal model looks at what you saw on the previous slide, which is price to book. It looks at price to earnings. It looks at dividend yield. And it also looks at a comparison of the yield on the Nifty 50 earnings yield as compared to the 10-year GSEC yield. Now, what you can see here is that the long-term difference is about 1.1%. The current difference, or rather it is minus 1.1%. The current yield difference is about minus 2.25%, which places it in a tactical territory which is tactically favorable for fixed income as compared to equity. So this is this is the fourth parameter which goes into our valuation model for the models that we run for our multi-asset and our BAF strategies. Moving on to the final slide that I'll be talking about today, which is sort of a summary of many of the things that we've talked about. First of all, US economic data has remained reasonably robust. The good news is that inflation has started to now significantly trend lower. But at the same time, due to the strength in US economy, labor market tightness, the Fed has been trying to push back on expectations of rate cuts. I think in January, when we were having this conversation, the markets were estimating 140 basis points of rate cuts during calendar 2024. That estimate has now been reduced to 100 basis points because given the strong growth and given the sort of pushback from the Federal Reserve, markets now expect about 100 basis points, so maybe 4 rate cuts. And I think the markets are now presuming that perhaps something could happen as early as June. In India, very quickly, I think given the fact that growth is now, second advance estimate at 7.6%, Jan 24 CPI coming in at 5%, the MPC is not in a hurry to cut rates, particularly because they are increasingly talking about a target of 4% for CPI. And with growth being positive, there is no reason for them to really rush to cut rates. I think an additional factor, which you can see the second point over there, particularly in the US context, is that in the US context, the Federal Reserve is now continuing its process of quantitative tightening, which means that they will be selling bonds. And B, the US is not really bringing down its fiscal deficit very aggressively. Last year was about 7%. Day before yesterday, the US presented its budget, though this is subject to approval and it could still see some changes. There's a slight reduction in the target for budget deficit of about 70 or 80 basis points, but the deficit will still remain well above 6% as compared to, let's say, India, where we are looking to bring that deficit down to 4.5% by FY26. So I think, the sort of trajectory that we have in India right now to bring down the fiscal deficit is quite aggressive. And that is something which makes the Indian situation very different from the US. In the US, I do think that this kind of high deficits combined with balance sheet reduction make it difficult for long-term yields to come down. We've already talked about Nifty 50 consensus earnings growth, 14% for 24 and 25. But there is dichotomy in valuations. Nifty 50 sort of at the top end now of our comfort zone, getting slightly uncomfortable, entering rich territory. The Nifty 150 and small cap, on the other hand, very clearly trading in rich territory, trading at a premium to large caps, and we are not very comfortable over there. So our general advice to investors, consider a staggered approach towards investing in equities, and even within that the bias should be more towards large cap. And for those who are looking to make lump sum investments, you can consider the balanced advantage and multi-asset schemes, which use the dynamic model that I talked about earlier for asset allocation. Currently, these schemes are running between 50-55% to equity as compared to the maximum of 80 or 90% that they can go to. And that's a reflection of what we think about valuation. Valuations. Those could be some of the schemes. So that's it from my side in terms of painting the macro picture. I'll now hand over to Vishal, who's going to talk about UTI focused fund. And this is a good fund to be looking at, particularly considering that at the current point of time, the portfolio has a significant tilt towards large cap companies. Over to you, Vishal.
Yeah, hi. Thanks, Vetri, and good afternoon, everyone. So today I'll be giving you an update on the UTI focused fund. Can we go to the next slide? So what is UTI focused fund? So as the name suggests, it's a concentrated portfolio, and as per SEBI classification of funds, we are allowed to invest in maximum of 30 stocks. So it's an exposure to high conviction ideas within our research universe. Secondly, it's very uniquely positioned because it's a concentrated portfolio. So if you look at the portfolio active share versus the benchmark, it's very high. So it will be at any point in time, I think currently it's around 73%. During the history of this fund, it's been always been closer to that number or around 75%. So it has a high active share. In terms of portfolio diversification, because we are carrying a concentration risk, we try to have the portfolio well diversified across sectors to mitigate the concentration risk. And also we run the portfolio with a blend strategy of growth and value. Again, not to take any excessive style risk, so have a blend strategy. And lastly, we have a 12-member research team covering almost 400 stocks. So we leverage their research expertise to construct the concentrated portfolio. Next. So what is the investment strategy and how do we come to the blend strategy? So if you look at the portfolio, we try to invest in ideas across three buckets. And the first and the largest bucket is sustainable businesses. I would say that is the core part of the portfolio. And I would say that that is also the largely the growth or the quality part of the portfolio. And lot of ideas in that bucket will also have an overlap with, say, other quality or growth funds you will see. So as the name suggests, here we try to invest in companies in which we find sustainable runway for growth, companies in which we find healthy return ratios and cash generation. And this kind of businesses generally we will find in sectors like consumer, IT, pharma, retail banks and NBFCs. So those kind of sectors will generally be predominantly found in this bucket. And as I said, this is the growth part of the portfolio. Secondly, we look for cyclical ideas. Cyclical ideas are companies which are cyclical in nature, where we think that they are currently going through a cyclical downturn and valuations are also attractive. And if we believe that the cycle is going to turn favorably, hence we'll have a opportunity to benefit both from mean reversion in earnings as well as valuations. And generally, we see this kind of companies we find in sectors like metals, power, capital goods, some part of auto like commercial vehicles, tractors. So those are the sectors predominantly where we find this kind of opportunities. And again, this is more the value part of the portfolio. Again, you will see this kind of companies in more value style of investing or the value funds. So this is the value part of the portfolio. And lastly, are the transformation or what we can call as turnaround opportunities. Again, here the companies are, we have companies which have good history, which have historically been doing well, but because of certain external or internal factors, they are undergoing a painful period or a bad phase. And if we believe because of certain triggers like change in management, change in competitive landscape, or change in regulatory landscape, we believe the company's performance could improve, which again could lead to good earnings growth as well as valuation re-rating. We try to identify such kind of opportunities. And this kind of opportunities could be found across sectors. So I think it could be found in any sector, be it a cyclical sector or be it a non-cyclical sector. And again, you will find this kind of opportunities also present in value funds. So both cyclical and transformation opportunities bucket are the value part of the portfolio, while the sustainable businesses bucket is more the growth or the quality part of the portfolio. And by trying to pick ideas across all three buckets, we try to create a blend of growth and value. So just to elaborate the point, what I have done is I have tried to give few examples across all three buckets so that I think, put the point across well. So if you look at the sustainable businesses, here I have given two examples. On the left hand side, you can see Trent Limited. If you see the longer term growth, they have done phenomenally well, growing at around 19% CAGR. In fact, in recent past, last 2-3 years, actually their growth has accelerated and they are growing at 30% plus. And they continue to grow. If you look at the 9-month financial year numbers, they have continued to grow well. And in the bottom, if you look at the return ratios, when they were small in scale and investing new stores, their ROICs were low. But if you look at it now over a period of time, except the COVID period, which hit all the retailers, their ROICs have continued to improve. And now they are comfortably about 20% plus. The second example again is very well known, Bajaj Finance. They have seen a phenomenal AUM growth over last 10 years, also reflected in the shareholder wealth they have created, and return ratios have been fairly stable. So, I mean, these are the two examples. There are many such examples of sustainable businesses, and you can we have more such names in our portfolio. Secondly, coming to cyclical opportunities, say taking example of IndusInd Bank, it's a bank which has exposure to some of the sectors which are more cyclical in nature, like CVs, commercial vehicles, or even microfinance. And both these segments have a cyclicality in terms of AUM growth as well as asset quality. So we'll try to obviously identify phases where the bank is going through a bad cycle and the valuations have also corrected, and if we believe the cycle can turn favorably and valuations are very attractive, we try to, at that point in time, invest in the bank to benefit from both the cyclical upturn in valuations as well as asset quality and growth. Next. Similarly, to give example of a transformation or a turnaround opportunity, on the left-hand side, like I have given example of Bharti Airtel. So if you look at the telecom sector, what has happened, transpired in last 7-8 years since Jio entry. If you look at the top table in FY 16 or 15, the ARPU or the average revenue per user on a monthly basis used to be almost close to 200 rupees for the telecom sector and for Bharti Airtel. Post the entry of Jio, which was the new telecom operator, there was a lot of pricing pressure on the sector, and ARPUs almost dropped to a low of 125 rupees in FY19. And in the bottom, you can see the correlation with EBITDA margins. So margins which were closer to 40% dropped all the way to 20%. And but during the same phase, we saw multiple telecom operators actually going bankrupt or going out of market. So from a scenario where we used to have 7, 8 players in the market, we are barely down to three private sector players in the market. Though there's been a massive consolidation, and a large part of market share in the sector is now with Bharti Airtel and Jio. And post FY19, we saw the market repairing itself as the market got consolidated, and we have seen ARPU now again going back to 200 rupees and margins also again recovering back to 40%. And similarly, we have seen the same in the stock price performance as well. We know the stock actually did quite poorly post the Jio entry, and in last 3-4 years, we have seen a good share price recovery in Bharti Airtel stock. Next. So one of the other things which I wanted to highlight, apart from the investment style and just carrying forward from what Vetri was also speaking, was on the valuations. We are now far more comfortable with valuations in the large cap sector, relate on a relative basis compared to both mid and small caps. So what we have done in this portfolio, if you look at it over a period of last 2 years, is that gradually we have kept on increasing the large cap exposure. So 2 years back, we had 66% exposure to large caps, which we have now increased to 82%, while mid caps have gone down from almost 28% to 18%, and small cap is now down to 0 from 6. So, and just to clarify, there is no restriction in with respect to market cap exposure in this fund. It's more of a call on the valuations, and it's more of a fund manager call. Obviously, hypothetically, if 2 years out we find the mid and small caps more attractive, we can always increase their weight. But as we stand today, I think the valuations are more comfortable in large caps, and hence we have tilted the fund towards more being a large cap oriented fund rather than a mid and small cap oriented. These are some of the stock entry and exits we have done over last 1 year in this portfolio. I would say the exits are a combination of either growth concerns or valuation concerns or any concern we have around the capital allocation in the company. So it's a combination of multiple reasons we had exited. And in terms of fresh entry, again, we have tried to, even when we are adding names to the portfolio, we are looking at all the three buckets. So for example, if you look at Astral and Syngene, they are more in the sustainable businesses bucket of the portfolio. NTPC is in the cyclical bucket of the portfolio, while I would say Tata Steel is more in the transformation or the turnaround bucket of the portfolio. So this is the portfolio as of Feb end. I think I'll want to leave here with this portfolio and this slide. I think everyone can look at it and then we can proceed for questions.
Yeah, sure. Thanks, Vishal, for the detailed overview on the fund, UTI focused equity fund. So we will now move on to take Q&A. So the first question is obviously to you, and from an investor's perspective, so how do you want to position UTI focused fund vis-a-vis other diversified equity fund at UTI? You're on mute. Sure.
So if you look at UTI focused equity fund, I think it differs from other diversified funds in two, three ways. I think one of the most important difference is that we are managing this fund with a blend style rather than a pure growth or value style. And I think just for if you look at this slide, if you look at if you look at this slide, you can see the UTI large and mid cap fund, UTI focused fund, and UTI flexi cap fund. The UTI focused fund we are managing with a blend style, while UTI large and mid fund is being managed with a value style, and flexi cap fund is with a growth style. And you can clearly see the difference in the portfolio characteristics. So if you look at the ROC tiers, if you look at the R1 proportion, UTI focused fund has 63% of the portfolio in R1, while the flexi cap fund, which is more of a quality, has 86% in R1, while the large and mid, which is value, has 51. Similarly, if you look at the price to book multiple or the price to equity multiple, focused funds price to book, price to equity is somewhere between a flexi cap and large and mid, which basically reflects the blend style of the portfolio. I think the other key difference from a positioning point of view, I would say, compared to the other diversified funds, is on the active share. Because it's a concentrated fund with less than 30 stock, maximum of 30 stocks. As I said, I think the active share of this portfolio will be somewhere closer to 75%. For instance, for example, like I manage the long-term equity fund, which is the tax saver fund, ELSS tax saver fund with a similar investment strategy, but that's not a concentrated portfolio. So the active share in that portfolio is around 66-67% compared to this portfolio where it is 73-74%. So I think the other big difference in the portfolio is that this portfolio will have a very high active share. And lastly, again, what we discussed earlier also, I think in this fund, what we have done more because of the relative valuation comfort, we have currently this fund is more of a large cap oriented fund compared to some of other sector funds which might have slightly different large, mid, and small cap exposure.
Yeah, sure, Vishal. Thanks for that insight. So the next question is actually to Vetri. So Vetri, with sentiments improving around the growth potential of Indian economy, the corporates are better prepared to take advantage of their delivered balance sheets, right? So, however, what according to you are the headwinds that could delay the growth expectations?
Yeah, sure. Thanks, Niranjan. That's a good question. And, in January, we had actually written in my monthly commentary about some of the risks which are there in the environment. But particularly, if you were to talk about the risks in terms of what could hold back corporate India from making significant investments, first of all, I would point to the fact that at this point of time, when you look at it in terms of capacity utilization, while capacity utilization is at a healthy level, it has not reached the point in time where companies actually come under pressure to invest and make sure that they have capacity to meet the future growth of the economy. Remember that we've anyway gone through 2 to 3 years of soft demand during the pandemic. Companies had already made their plans prior to that. So we may just have to be a little bit patient that some more capacity utilization increase might be necessary before companies get incentivized to invest aggressively. The second thing I think we need to keep in mind when we look at the investment plans is that, as I mentioned earlier, in India, certainly there is a case for, rate cuts. There is a case for yields to come down. Nothing dramatic, but some slight downward drift in cost of capital should be expected. The only sort of factor which is running or may pose some risk to this is the fact that in the US, inflation remains well above their target level. And secondly, because of the high fiscal deficit that I talked about earlier, and also because the Fed is trying to bring down its balance sheet, it becomes very difficult for long-term rates to come down. So even though in India we have more headroom for rates to come down, given that the US, Federal Reserve interest rate policy, in a sense, impacts and transmits into all other markets worldwide, that could be a cause for concern that particularly if the long end yield stays resilient, that could impact companies in terms of how they gauge the attractiveness of projects that they would wish to invest in. So these, to my mind, are two sort of key risks to watch out for in terms of not necessarily completely holding back an investment revival, but maybe this could, sort of delay the kind of pace one might expect in terms of a significant investment revival. The final point I will make, Niranjan, is slightly different. I think today we are also in an environment where companies are having to consider making investments in completely new technologies to meet some of the evolving challenges that we as a country and economy face. This has got to do with the transition away from fossil fuels. It has got to do with a whole new range of technologies, whether it is in the realm of battery storage, whether it's in the realm of automobiles, the entire EV space. And many of these are large scale investments, but the payback period and the returns are obviously slightly more at sort of risk from companies' point of view. So in a sense, they may be slightly cautious in terms of how they go about making these investments. Now, government is doing what it can in terms of rolling out schemes like the PLI, which would at least enable some companies to get more aggressive because effectively they are receiving a capital subsidy to make these investments. But I would say that's the third sort of risk, that companies are entering new domains that they are not fully conversant with, and therefore they are likely to be slow because they don't want to have any missteps.
Yeah, thanks a lot, Betty, for that detailed explanation. Just a reminder to our viewers, so keep coming, let your questions keep coming our way. So we will try to take as many as questions as possible. So the next question is to Vishal. Vishal, the government's benign policies and regulations are likely helping some of the PSU companies to perform well in the recent times, right? So, however, are there any major risks to the current valuations, right? So, which are actually seen in some of the pockets, right? So, what is your call on such what is it, companies, and also how do you view that from the fund portfolio point of view as well?
So thanks, Niranjan. So actually, if you look at our portfolio, we have been quite selective with respect to PSU companies, investing in PSU companies. We have obviously looked at their historic track record with respect to execution, return ratios, cash flows while evaluating those companies. And we have been obviously being very mindful of the valuations compared to their own history and where we are in the current cycle. And as you rightly mentioned, there are some pockets of PSU where valuations have become very excessive compared to their own long-term growth potential, earnings potential, and hence we will be very careful of that. So we continue to remain very selective, and obviously both on valuation side and on in terms of their execution.
Sure. Thanks, Vishal. There is another question on pharma sector. So, while you are actually neutral on this particular sector, right? So, about 5% allocation. So, what's your view on this sector? Do you take a top-down view on the sector, or is this a totally bottom-up selection in this sector?
No, I think it's a combination. So just to come to outlook first, I think the outlook remains fairly stable. So what we have seen over last 12 to 18 months is that the pricing erosion, I mean, there was a lot of competition in the US markets, due to which there was a lot of pricing erosion happening in the US markets, say for many years. In last 12, 18 months, we have seen some bit of reversal in that. The pricing erosion has moderated as competition has reduced, and because of that pricing pressure in the earlier years, a lot of players went out of the market or the supply reduced, which has helped the competition to reduce and leading to lower pricing erosion. What has that led to is that led to margin improvement for companies which are exposed to US business. The Indian market remains fairly stable. I think the Indian pharma market continues to grow largely in line with nominal GDP. I think that will continue. So outlook wise, I think it's fairly stable, and this moderate pricing pressure in US markets, I think, is expected to continue for some more time. And I would largely say, because if when we talk to and if you look at any of the Indian companies or any other companies, as of now, they are not looking to increase their investments in US markets. So as long as that is not happening, it means that the competitive pressure will remain benign, which is good in terms of pricing erosion. So I think outlook wise, it remains fairly stable. Coming to your point on neutral, I think we were at some point in time overweight. I think it's largely a function of valuations. So valuations which were very favorable a year back. Now I think Nifty Pharma has almost given 65% return in last 1 year. So valuations obviously are no longer as favorable, and that's why we are more on the neutral side in the sector.
Sure, Vishal. Thanks for that. Vetri, there is a question on something related to artificial intelligence. So, and primarily, if you have to look at IT services and the global capability centers are the two main levers of services exports growth in India, right? So, however, if AI is expected to disrupt the sector, how is India's job landscape is actually likely to play out in impacting the growth? And also, some of the data or the trends suggest that there are 16 million working employees in India which may need reskilling or upskilling because of that. So, what is your take on that? If you can share some insight.
Well, actually, Niranjan, let me answer the latter part first. I think we have seen this, and particularly in my conversation with tech companies, which now go back for almost 3 decades. Every time, not every time, but every 5 to 10 years, there is a new cycle which comes in terms of the technology tools that are used. There is a new cycle which happens in the kind of products that companies are using, and therefore it requires people to be reskilled. So this is not unusual, right? I mean, we had people who were trying to fix the Y2K problem pre-2000, and then 4 years later, these people were the people who started implementing, programs like SAP, which were enterprise-wide software, which was a very new concept in the early 2000s. And then, of course, in the last few years, we've seen the rise of people involved in, SaaS, in cloud-related computing, and those kind of things. So every 5 to 7 years, there is a new cycle, and you need to reskill your employees to do that. I think without doubt, the same may be very well true for the IT industry at this point of time. I must admit, Niranjan, I don't have a crystal ball. It's very hard to sort of look into the future and say to what extent the rise of AI will sort of dent the demand for manpower. Certainly, it cannot be ruled out. It is not a zero probability event. There may be a period where the industry will have to reskill its resources. But I think what we have also seen from past experience of cycles over the last 20 to 25 years is that every time a new technology enters, there is a certain kind of work which gets replaced by that new technology, but work gets created upstream of the technology. Right. So there could be a phase where the industry goes through a little bit of churn. Maybe some of their historic business lines start to slow down, but a new business line, which is, upstream of AI, will start to emerge. And companies which have been able to reskill their people will then be able to create a new growth engine out of that. It's very hard to imagine all the moving parts at this point of time. Certainly, we cannot underplay the risk that is likely to come to many jobs simply because of the rise of AI, which could take over some of the basic computation and data crunching roles that people are currently doing. We cannot underplay that risk. But over the medium to longer term, I am reasonably optimistic that AI can benefit India in two ways. One, it can be a productivity enhancer in the Indian context. And secondly, as I said, the minute a particular kind of technology becomes widespread, the demand for technology solutions moves upstream of where that new technology has come. And as long as the Indian companies are able to retrain and get on top of those new technology skills, I think they will be able to ride the curve. But will every company do it? Will every company be able to execute as well? We'll have to wait and see.
Sure, Vetri, thanks. So the next question to you again. So this is coming from few of our viewers online on our underperformance of a FlexiCap fund. So the relative underperformance of the quality growth strategy has been sticky for some time now vis-a-vis the blend or value strategies, right? So this is actually inducing investors to basically chase funds with better performance in the recent periods. So what is your advice to the investors who could actually anchor to the right investment strategy and also share some update on this?
Sure. So good question, Niranjan. I think, when we very transparently discuss with investors our investment process and the style with which each strategy is managed, and, like in the slide which Vishal talked about, we look at every portfolio in terms of what are the inputs which have gone into that portfolio, in terms of the kind of companies, their return on capital profile, their cash flow profile, what kind of aggregate valuations the portfolio trades at, because all of these go into determining what kind of philosophy that portfolio is running with. What we believe is most important is to be able to run with a particular philosophy and approach over a long period of time. There will be some seasons where that particular approach will be stronger in terms of alpha. There will be some periods where it will be weaker in terms of alpha, because market moods are volatile, market moods keep changing. But we still think at this point of time that, being disciplined about the strategy you follow is very, very important, rather than trying to change strategies at every point of time. And what we have always told investors, Niranjan, is that use style diversification as a tool for portfolio diversification at your end, which is to say, don't invest only in strategies which are quality growth, only in strategies which are value, only in strategies which are momentum, but choose from different strategies, because that is what will give you a more diversified portfolio, not diversified by stocks, but diversified by style. So that's the message that I would continue to give out, that remain diversified by style. There will be periods when one particular style looks out of fashion. And there's a very famous line by an American comedian, George Carlin, which comes to my mind. And he says, in the context of driving on the highway, that why is it that everybody who's driving faster than me is a maniac, and everybody who's driving slower than me is an idiot? Right? But that's the way we approach fund performance. But it's nothing to do with the fund itself being good or bad. It's a function of the fund having a particular approach. Quality growth has not done well over the last 2 years. But I also think, given where we are positioned in the valuation cycle, the kind of extreme outperformance of value that we've seen over quality growth, there is a case for a inflection point sometime here. We don't know when and where. It's hard to predict these. But my message to investors will be, practice style diversification. That's the best way to ride out the cycles in the market.
Sure. Thanks a lot, Betty. Very well articulated. So, Vishal, there is a question to you on focus fund now. So, is your strategy open to explore some of the niche opportunities with high growth potential? And if yes, what is the approach that you follow to identify such opportunities in the fund?
No, obviously the fund is open to investing in any kind of opportunity, and the approach actually remains fairly similar to how we'll evaluate any other opportunity. So, I mean, coming specifically to say companies with very high growth potential, what we have to evaluate very carefully is the unit economics of that. So, if the company is able to sustainably grow while generating return ratios which are above cost of capital, then obviously it is value accretive. Growth at a return ratio which is lower than cost of capital obviously is value destructive. Similarly, is the business generates enough cash flow to fund its growth? If a company is growing at a very high rate while relying completely on external funding in terms of borrowings or equity, again that kind of growth is not sustainable. So we have to be mindful of such things. We again, as I said, focus apart from growth, the focus will be on cash flows and return ratios. The only difference in approach might be that if some of these companies might have a short period of history, maybe they are startups, e-commerce companies, or any other company with shorter history, we might, and if we like, even if we like the company, but we have a lack of sufficient history, we might start with a smaller position. And obviously, as we get more comfort on the business model, management, execution, we can try to build on that position. So I think that would be the only difference, maybe. But obviously, fundamental approach doesn't vary.
Sure. Thanks, Vishal. So, in the interest of time, I think we will take last two questions for today. So, Vishal, again, one question to you on the consumption cycle. So, there are signs that the consumption cycle is slowing down despite of improving GDP numbers and also the overall economic factor, right? So, what are your thoughts on the consumption sector performance in the near to medium term?
So I think again this has been fairly discussed in detail. The whole K-shaped recovery. What has happened is that the upper end of the segment of consumers have seen their incomes grow, while at the lower end, one there's a pressure on income, and more importantly, the impact of high inflation is also felt on that segment of the consumer because their disposable income is anyways low. So this twin impact of high inflation, lower wage growth leading to lower disposable income growth, or even a decline in disposable income growth actually has impacted those segments of consumption which are more catering to the lower end of the consumer. So, I mean, if you look at five-star hotels, airlines, SUVs, the premium consumption has continued to grow. But the lower ticket consumption, FMCG, or even QSR companies, lower end apparel, footwear. I think at the lower end and the mid to lower end, everything has got impacted because of this. My view is that as we see moderation in inflation, and obviously as we see income growth in that segment of the consumers, I think basically the disposable income for that segment of the consumer needs to grow for them to start spending again. And as obviously GDP growth happens and it percolates in terms of wage growth and in terms of job growth, and as inflation, obviously inflation will happen, but at a more moderate level. I think combination of all these factors should lead to a revival at the lower end as well.
Sure. Thanks, Vishal. There's a follow-up question also. So, which are the sectors you are currently bullish on from a medium to longer point of time?
I think if you, I mean, just to start with the overall consumption space, I think in the overall consumption space, we fairly remain bullish on the discretionary consumption compared to staples. Their penetration levels are fairly low. Those sectors have actually also seen some bit of valuation derating in last few years, as we already pointed out, the growth has not been there. As growth recovers, I think that is one good space to be there. Uh, Pharma, we remain bullish and the outlook remains good. But as I said, valuations again are not as favorable as it was a year back. But fundamentally, I think the outlook remains healthy. Auto, if you segment the auto between two-wheeler, four-wheeler, commercial vehicles, and tractors, I think the outlook for two-wheelers and four-wheelers still continues to remain healthy. Four-wheelers, anyways, there's a long-term story of low penetration which continues to play out. Commercial and vehicles and tractors are seeing initial signs of slowdown as they are more cyclical in nature. So they had few good years. So obviously there is a possibility that they might have a few years of downturn. So that is on the auto sector. IT sector, I think the longer term outlook remains fairly good. What happens in near term is fairly difficult to call with respect to what happens with US and European economies with respect to their growth. And on the valuation side, I would say IT sector is not as cheap as it was, I think, some time back when they were beaten down. I think so. IT sector again positive from a longer term point of view, but from a near term point of view, we'll have to see how the economic growth revives in the Western countries. Uh, on the manufacturing on the Capex side, I think the Indian government fairly remains committed to having a Capex cycle revival, and those sectors we have already seen seeing some bit of revival in last couple of years. But again, I would say valuation is a big challenge in some of those sectors. So I think that is the issue there.
Thanks, Vishal, for putting across and also summarizing the outlook on the most of the sectors. So thanks for that. So one last question for the evening, and yeah, this is to Vetri. So Vetri, what are your expectations on remaining part of the year 2024 to pan out from equity market point of view on the backdrop of upcoming elections in India? I think expected to be in April, May, and again later during the year, somewhere in November in US, right? So, and also on the backdrop of elevated valuations across the market cap spectrum as well.
Niranjan, you have already mentioned laundry list of factors over there. I wish there was a sensible way to weigh all these factors together. But I will give you a very boring answer, which is that please practice the asset allocation framework that you have chosen to work with in terms of the kind of asset allocation goal, I mean, a framework that you are using in order to achieve your long term financial goals. In the market, there will be always something exciting going on, there'll be something boring, there'll be political news, there'll be economic news, valuations will be rich, valuations will be poor at some point of time. Stick to your asset allocation goals, stick to your investment plan. It should allow you to reach your goals. All of this is very exciting, but don't tilt at your investment plan just based on these factors, because as I said, there are so many factors, it's impossible to know which one will prove to be material. So I would just say stick to your investment framework and your asset allocation goals.
Sure. Thanks, Vetri. And I think that's a wrap for today. So, just a request to the viewers here today. Please use the feedback link available on the screen to share your feedback on the topics that we covered today, and also feedback on the webinar in general. So that will always help us to do better. So, with that, I think thanks everybody for sharing your questions. That will always help us to keep the webinar engaging, right? So, and if there are any questions that we have missed out, you can always approach our relationship managers, or also alternatively, you can write to us at ask.uti at the rate of uti.co.in. I'll just repeat, ask.uti at the rate of uti.co.in. So, with that, I think thanks, Vetri and Vishal and all the participants. Hope to connect again in the next month webinar. Thanks a lot.
Thank you, everyone.
Thank you. Thank you, everybody. Have a great evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.